My name is Evan Bradley. I'm the Chief Financial Officer for Campbell Property Management. I'm one of the 5 owners of the company. And I'm also a licensed CAM, and I work with some of our largest clients on the major issues facing their associations. For those of you not as familiar with Campbell, we've been in business since 1953. We manage over 400 HOA and condo association clients from Dade to St. Lucie counties here in South Florida. And we have Paul Mack with us today to help us understand a little bit about the state of the condo insurance market. He is with Mack, and Waltz, a leading HOA and condominium insurance firm. So he specializes specifically in this market, and he has he's a wealth of industry knowledge. So Paul, would you like to say a little bit about yourself and the firm?
Sure. Thanks, Evan. Can you hear me okay?
We can. Great.
Awesome. Really glad to be here. Mack, and Waltz has been writing community associations here in Florida since 1993. My firm has over 3,000 communities that we write in Florida, and we are an industry specialist. We got a lot to talk about today about insurance and what's going on in the market, so I look forward to our chat.
Thanks, Paul. Just a reminder, this is for informational purposes only. This is not legal advice. This is not insurance advice. If you have questions about your specific community, your policies, your condo, please do reach out to your management company, your agent, or your attorney. Do take advantage of the Q&A. The question and answer feature of Zoom is open today. We will try to get to questions at the end. We're going to probably not pause in the middle, but do please keep those questions relevant to the course material and at a high level. We're not going to be able to answer specific questions about your condo or your policy. So all that being said, here's a little bio on Paul Mack, and his contact info is there for those of you who may be interested. So go ahead and jot that down real quick. And we will put this up again at the end. All right. So our agenda today, we're going to briefly go over insurance basics for associations. Your insurance vendor is a little bit different than your other vendor relationships. We're going to talk about the state of the market currently. I know it's something that interested a lot of you in the registration. Probably the most common question, what should we expect in terms of rates for 2022? How can we reduce rates if possible? And how do we communicate and plan for increases? And then we'll try to take some questions out of the Q&A. So, Paul, let's go over the basics a little bit, because this is kind of a very different vendor relationship than some of the others the association might have. Starting kind of with the most basic question, though, this was kind of a common one. What insurance must the association carry? And is there a self-insurance option?
So let me address the first part of that question. There are a handful of insurance policies that an association needs to carry. Most commonly is a property insurance policy. So we're covering the buildings for a condominium association. In the case of an HOA, they could be other type of improvements, clubhouses and auxiliary property. So that's a very common policy that we see. A general liability policy. General liability covers the premises from hazards like slip and fall. So that is another policy that associations need to carry. A directors and officers insurance policy is very important to have, because it's basically management malpractice coverage, and it covers decisions made by the board and the management company. Finally, there's a crime policy or a fidelity policy. And that covers the association funds that sit in bank accounts, and they could be stolen by a whole variety of sources, outside people, and it covers the funds that the association is holding on behalf of the members. Also, an umbrella policy is really important to have, because the director's insurance policy and the slip and fall policy generally limits end at $1 million, and that's just not enough in today's world. So we buy an umbrella policy that covers over and above when the policies are exhausted. So those are the common policies, the basic policies that we see in almost every single association's portfolio of policies. And then regards to the second question, can they be self-insured? And this comes up a lot. So years back, there was a self-insurance trust that was created. That was the closest thing to real self-insurance, and it really wasn't self-insurance. Self-insurance in itself is a thing. So there's funding for it. There's excess insurance over a certain amount that an association would buy, and it's just not practical for several reasons. Most commonly is anybody that is buying a unit inside a condominium association that is getting a loan from a lender. The lender is going to require it that the association have insurance from an insurance company that's licensed and approved. So that's the most common reason why it doesn't work. And the other reason it doesn't work is just because we're exposed to catastrophic risk here in South Florida. And whenever there is exposure to catastrophic risk and the frequency is high, self-insurance usually just is not a good option.
Right. So we know they have to buy insurance. They have to go to the insurance market. So what is the role of the insurance agent? What is your role in this process?
The insurance agent has a very important role because even insurance companies that sell insurance directly, they have to have a licensed insurance agent to sell it. So it's very important that the insurance agent that you're dealing with understands community associations, because the agent is the conduit to the insurance companies. So the role of an insurance agent is to seek out the best insurance companies that can that can provide the coverages. And agents like me are independent, so we're not tied to any one particular company. So we can go out and cover a variety of markets. And in Florida, the market is fairly limited. And it's important that the insurance agent that the community has engaged has a good understanding and has the connections with the correct companies that can get the policies effectively placed. And also, an agent's role is advice and counsel. So, with rates going up and things happening, you need to know that you can count on your agent to give you some good, solid advice on how to get the best deal you possibly can.
So how does the association shop its insurance or bid out its insurance? Does it change its agent, or how does that work?
Yeah, this is kind of a lot of confusion what happens here, because like you started saying that the relationship with an insurance agent is very different than other vendors. And once a community has an understanding as to how this works, they're going to be in a better position to be able to negotiate. So oftentimes communities think, hey, let's go talk to 10 agents because we're going to get 10, bids from agents. And that's not the way it works, because the insurance companies will only talk to one agent at a time. So because in Florida, there's a really limited number of companies that will write. I mean, there's lots of companies that write, but most of them aren't going to be competitive for one reason or another. And it's really important that the agent have connections to those carriers, like I said, but they're only going to deal with one insurance agent at a time. So by engaging multiple agents, you're not getting multiple bids. And you need to sign what's called an agent of record letter. And basically, it's important that you have the right agent, because even though the company's rates are filed and they're only going to give one bid, the agent's role of negotiating that and the end result of what ends up the program that the association ends up buying is highly impacted by the insurance agent.
So how does the association know they're getting the best deal if they're locked into one agent?
So that question is a great question, and you have to have trust in the agent that you're dealing with, because if you engage multiple agents and one agent is covering the marketplace, then you're not going to be able to engage multiple agents. So the key is to choose an agent that can do the job and that you can trust, and that's going to go to those markets. So an agent, when he or she presents his or her proposal to the association, should put a page in the proposal of all the companies that they've gone to and what those companies have quoted. So in transparency, the board can see what that agent has done on their behalf, and they can show the residents that there's been a diligence process and they haven't just relied on one person to give them, one quote.
Right. And this is another common one in Florida. We already had someone in the Q&A bring this up. What is the difference between an admitted and non-admitted carrier? It's very unique to Florida.
Yes. Two big differences between admitted carriers and non-admitted carriers. The admitted carriers, all carriers are approved to do business in the state of Florida, or you shouldn't be doing business with them. But all carriers that we do business with are approved. But an admitted carrier has a higher degree of regulation. So the state has to approve their forms and their exclusions, and there's a little bit more consumer protection there. And then the other big item is admitted carriers participate in what's called FIGA, the Florida Insurance Guarantee Association. And if they go bankrupt, the state stands behind them, whereas non-admitted carriers are there to take more risky deals, and they don't participate in FIGA, and there is no backstop.
Gotcha. Now, does an association have to be with an admitted carrier?
No. An association doesn't have to be with an admitted carrier. And in the present market that we're in, a lot of times an association won't even get an option to go with an admitted carrier. So again, going back to the agent's role, it's really important that your agent is vetting these companies and making sure that the non-admitted carrier you're dealing with has a good, strong rating, and the association, the board, can ask questions about their rating and their ability to pay claims and their service and all those important factors.
Thanks, Paul. I think we've got the basics pretty well covered there. So now that we understand the very basics of how this works, a lot of people were asking about the market. We all know the market is trending up. Condo and HOA insurance rates, but particularly condo, have been increasing. Why are we seeing these increases, year over year, the last couple of years?
Yeah. Several factors, and we don't have time to get into all of them. I think we could do probably a webinar on this, but really what we're seeing is climate change is having an impact on rates. I mean, from 17 to now, even though South Florida hasn't been hit other than Irma, we're seeing back to back storm seasons, and it's reducing capacity in what's out there. So that has a big impact on it. Interest rates have a big impact on insurance rates. Why? Because when interest rates are high, insurance companies can get a lot of premium in it and invest the difference, make up underwriting losses. But they can't do that when interest rates are low. So there is less incentive for them to do that, which triggers supply and demand. When there's less carriers writing, and there's always a high demand in South Florida. We always see it down here because we're so highly developed. And that's why, in a short answer, why we're seeing increases right now, increases in the amount of catastrophes that we're seeing and low interest rates in a low interest rate environment.
And the increases seem pretty large. I mean, what is the reason for that?
Yeah.
Same reason?
Yeah, same reasons, but what's happening is a correction in the market. So some associations are seeing a 20% rate increase, which is pretty large, which is kind of the average right now. But some are seeing 40, 50, 100%, and in some extreme cases 200 and 300%. And why are we seeing those? Because there's an adjustment that needs to be made on that particular account. Maybe that particular rate was way inadequate. Maybe the values aren't correct. We're going to get into some of the reasons why. So. But right now the 20% is about an average rate increase. And, I believe you have a slide that shows us where we've been in the market, but typically, these hard market cycles don't last very long. This chart here is from 2005, and you can see after Wilma in 2005, we had a sharp increase in rates, and then it kind of leveled off, even went down a little bit, all the way into where we're seeing kind of flattened out there. And then we saw a bit of a decrease. So if you look at where we started in 2005 to where we were right before we started seeing a sharp increase again, the point is markets fluctuate, and I assume they will again, because historically that's always the way it's been. Whether it's government subsidies and rates, which we're not seeing now, but that could be another reason as to why the rates would go down.
So Surfside obviously is on everybody's mind. Is Surfside having an impact on the insurance market?
Yes. Yeah, it is. It is having an impact on the insurance market. It's bringing to the forefront with these insurance companies that they need to underwrite properly. So, when we go in these soft cycles, insurance companies want to grab as much premium as they can. They're pressured to write business. Now they're taking a hard look at, because obviously that's a catastrophic loss, and none of these insurance companies want to be on a risk. God willing, that never happens again. But it's prompting them to look closely, looking at these 40-year inspections very closely. They're going to want more documentation going forward.
Right. And Irma, although that was, I'm going to say over 3 years ago now, we are still seeing some Irma roof claims. How has that impacted the market?
So much so that legislation was passed last year, limiting when you can bring claims, actually decreasing the time period. So you had 3 years, now you got 2 years. Looking at the numbers from Irma, when Irma first hit, the estimate was right around $1,900,000,000 is what the industry thought they'd pay from Irma. And here we sit, 4 years later, and the industry losses are over $3 billion, primarily because of people reopening claims, talking to roofing contractors, public adjusters, lawyers, and pushing the insurance companies to pay for a loss that the insurance company didn't expect to pay.
Right. Yeah. So another issue that we've kind of heard that's trickled out of Irma is the age of these roofs has been under scrutiny, and the condition of older roofs. Some are maybe being excluded or not fully insured, roofs between 10 and 20 years old. What are you seeing there in the marketplace?
Yes, we are seeing a lot of that. Insurance companies are looking very closely at the condition of the roof. And with technology today, between satellite imagery and drones, they're able to get a really good look at what they think the conditions of these roofs are. And with technology, they benchmark things. So if the underwriter feels that the roofs aren't in good condition, for fear that the insured could hire a public adjuster or a lawyer and put them in a position where they need to pay a claim that they may not have had to pay, they're paying particularly close attention to older roofs. Or if the roof isn't at the end of its life cycle, they're still going to want a third-party inspection, or they're going to want a roofing contractor to certify that the roofs are in good condition, good working condition. And we're seeing this very often. And a lot of associations come to us and say, hey, our roofs aren't leaking, they're fine. We understand that, but the insurance company is not going to be in a vulnerable position that they've learned their lesson from Irma.
Right. Well, one thing we're hearing about is maybe they're insuring roofs not for full value, but cash replacement value. Can you explain a little bit how that works if somebody hears that term?
Yeah. So replacement cost is new for old. So if your roof is older and you have a loss, you want the insurance company to replace the roof and put a new roof on. That's replacement cost. That's what you want. But if the insurance company is a little skittish and they think that there might be something wrong, where the roof is at the end of its cycle, you're at the 20, 25 year age of a roof, they'll just say, we're going to give you actual cash value, which accounts for depreciation. So you're going to get old for old. You're not going to get much for a roof that's at the end of its life cycle. Effectively, what that does in plain English is it eliminates coverage for your roofs if they're damaged by fire or hurricane.
Right. So if you hear actual cash value on an insurance policy, you better pay extra close attention.
Right. You better question your agent as to why this is happening or what you can do. And frankly, right now, maybe if the roof is at the end of its cycle, your agent may not be able to get you an option, or it's going to be a lot more money.
Right. And you may need to replace the roof.
Or you may need to replace the roof.
Right. Okay. We've talked a lot about property. Obviously, that's the biggest component in most policies, but are other lines being impacted in the marketplace, GL or umbrella potentially?
Yes. So, with a condominium, property is usually the biggest ticket item in the portfolio. But for HOAs, general liability, the GL stands for general liability, could see a significant change, and that's the second largest policy in most associations' portfolio, covering slip and fall. But we're seeing a sharp rise in those policies as well, primarily because of the cost of claims. Something called social inflation. You could Google social inflation and what it means. It's basically society's way of punishing big corporations and making what society thinks is a a justified judgment, and those are rising sharply, and the number of claims are rising sharply. Also, directors insurance is going up. COVID is really changing that marketplace. So I expect the directors, while fortunately it's not a big ticket item, it's going to be harder to get, and it's going to become a big ticket item for some associations that have claims.
Right. Okay. So going back to this slide real quick, although, it does show a sharp increase and kind of a level off, then actually some big decreases. This is an example condo with a $500,000 policy. If you actually take this and you figure out what the rate of inflation was over the last 16 years, it's under 5% annual increases average. Now, obviously this market fluctuated quite a bit, but if you average it out, it has not been totally unreasonable. But obviously, depending on when you bought your condo or home here in Florida, this could have a big impact on you. So what to expect for 2022? I think you touched on a few of these items earlier, but let's get into a little more detail. What do you think the market is looking like this upcoming year?
So the average we're seeing is about a 20% increase. So I guess I could say it differently. If the association is doing everything they possibly can and they get a 20% increase, that's pretty good in this market. So that's but what we do is, for our clients, when we're budgeting, we kind of want to peek behind the curtain a little bit and give the client an accurate number. So the first thing we do is benchmark where their current rate is. We have some that have had exceptional deals for one reason or another. Sometimes companies do aggressive things. Sometimes they do things they really don't even know they're doing. And now those things are easily, with technology, discoverable by insurance companies. So we're seeing things that are under market rates. We're advising our clients, look, you're probably not gonna see an average rate increase. So 20% is the average if the rate is adequate, the valuation is correctly. We talk about that, like insurance companies are looking hard at that. Cost of construction is going up. And if associations aren't insuring the full amount of the replacement valuation, then that's going to tip off the insurance company to raise the rate significantly.
Mm-hmm. Some things people should look out for. I mean, are you seeing changes in the insurance terms? Maybe the same carrier, but they're adding exclusions, changing deductibles, that sort of thing.
In a very common situation, you could see an association that has a 2% deductible get a 20% increase, and then the insurance company say, not only are we raising the cost by 20%, but we're raising your deductible from 2 to 3, or from 3 to 5. So we are seeing those increases in deductibles, and there are ways that which we'll get into in the section, where we can control costs. Sometimes you might want to be proactive and say to the insurance company, well, give us the options to look at raising deductibles, and does that save us any money in doing that? It's not just the deductibles that we're seeing changes in terms, particularly with non-admitted carriers, particularly it's with associations that have claims. Lots of slip and fall claims. The admitted carriers are saying, we're not going to write you anymore. And now you've got to go to the non-admitted market where they can put exclusions. Really, really important to have an agent that understands community associations, knows where to go, and can vet these properly, because the last thing you want to do is be reading these, very complicated policies and try and figure this out yourself.
All right. So nice segue, Paul. We have everyone sufficiently scared. How can we reduce rates? I mean, what can you do to bring these increases down, if at all?
Valuation is important. When we have an appraisal that's properly evaluated, because inflation, insurance companies know what they cost. Now, you don't want the insurance company to set the valuation, because that's like letting the IRS do your taxes. But at the same time, they know what's reasonable. Example, we got one right now where the insurance company says, this is valued at about 40% less than what we think it should be. And, you want this valuation, that's fine. We're going to put a coinsurance clause on the policy. And for those that don't understand how that works, is if they put a coinsurance clause on there, it gives them the ability at the time of loss to penalize you if you're not insured to what the coinsurance requirement is, 80, 90, or 100%. So it's a really good tool for them, which we don't like to put in policies, but That's one way, because what they're going to do is say, fine, you know what, you don't want to value it properly. We're going to charge you as if it was, and you're going to be charged more, and you're going to get less insurance. So that's not telling you how to reduce rates, but you can get more if you have a proper valuation, and you're in a better position to negotiate with the underwriter, which is why I bring it up.
Building improvements was one a lot of people asked about. What can people do to their building to bring the rates down?
I would say the top two are the age of the roof. So if the association is thinking about doing a new roof, I mean, you're not going to realize the savings in insurance right away, but it is going to have a tremendous impact. I mean, we have some associations where it's hard to get insurance at all because the roofs are old. But that has one of the biggest impact on modeling, as does the opening protection. So impact glass. If an association is looking at their buildings, or if it's a single building and they've only got a few units that are not fully protected, and it's prohibiting the association from getting that modeling, then we're seeing more associations that are putting pressure on those unit owners to do that, because it could have as much as 20, 30, 40% cost savings, which is significant in this market.
I know I've seen associations where one or two owners are preventing from the entire association from saving over $100,000.
Yes. Yep.
And there are ways to, like you said, put some pressure on those people and address that. So the next thing was a question about full replacement. Do you, these boards need to make sure they're insuring for full replacement, correct?
Absolutely. That is a really strong piece of negotiation when, as an association's insurance agent, when I'm negotiating a renewal, I could say, hey, look, we got adequate insurance to what we call ITV, insurance to value. And that puts the underwriter's guard down where, okay, you know what? I know if I can charge a fair rate for this, I'm getting the right, because think about it. They're charging a rate per $100 of value that you buy. And if you don't buy enough, they're not collecting enough money. So that's why that is such an important piece to negotiate. Not only that, you need that, God forbid you have a disaster where, you have a total loss. You want to make sure you're covered properly.
Mm-hmm. So we had a couple people ask, we've been talking about appraisals a lot, just for some clarification. How is the insured value determined, Paul?
It's determined by the square footage of the building and the type of construction that it is. There's different classes of construction that the insurance industry ranks, and those classes are the cost per square foot it differs based on the class of the construction. But with materials going up and things like that, I mean, some of this is kind of an inflated temporary inflation, but the insurance company does want a fair valuation.
Right. And I had some people ask, is it a reserve study, or where does that number come from? There are insurance industry appraisers, correct?
Yes.
Who actually perform that work for you.
Yeah.
So it has nothing to do with your reserve study or any other valuation you might have. It comes directly from an insurance appraisal.
That's right. And sometimes the reserve study consultant can do a replacement value appraisal, but you're right, it is not the same. It is not the same valuation.
Right. So what can associations look at if they can't change the roof, if they can't put impact glass on the building or make sure that all the owners have impact glass? What else can they look at? What policy levers can they tweak maybe to drop rates a little bit?
So they can look at their deductibles, see where their deductible levels are. There are still far few, but there are some that are still at a 1 or a 2% deductible option when it comes to hurricane, which is very low. And they might be able to save some money if they go up to 3 or a 5%. Got to understand that they're taking more risk, but that is probably the greatest impact. And for some associations, the insurance companies say, particularly the smaller ones, the insurance company says, look, we're kind of at a minimum level to write this. So even if we bump you to 5, we're not going to save that much money. So I think you got to be a bit prudent when you're evaluating the risk versus the savings. It's not going to be a savings for everybody, but hopefully, it will. And it's something that you can evaluate to make a decision. We're seeing some associations doing wind buybacks when the market's soft. They want to buy that down as low as they can because rates are cheap. So evaluate those policies. Is it really a good time to be buying that? So, look at deductibles on all your policies, even liability if costs have gone up. Law and ordinance coverage is critical to have right now. Talk to your agent, make sure you understand how that works. But there's some components of that can be adjusted, and there could be some nice savings there if we have to get those numbers down. It's really important that they understand what coverage they're giving up, though, because I wouldn't recommend you just cut the coverage to save the money. Really get a good understanding, and again, that's where that agent comes in. That's invaluable. So he or she can explain the risks you're taking, and the board can make a very informed decision on what is the best route for them to take.
Right. And I know we do have some HOA people on, and the largest component of their insurance may be their liability, umbrella, or D&O. Some things they can do, walk the properties, identify safety hazards, early, try to eliminate the potential for slip and fall type issues. Those type of claims will drive your premiums up. On the D&O side, rely on your professionals, rely on your management company's advice, rely on your attorney's advice. Do not put yourself in situations where you're going to open yourself up to D&O claims. Again, those can really blow up your insurance policies, especially if you have an open claim when you're going through renewal. So there are things you can do on that side as well.
Yeah, that's a great point.
All right. So inevitably, I think a lot of associations, and particularly condos, are going to have increases, some of them substantial. So how do we communicate this? From a management perspective, the best thing you can do, like anytime you have a problem, is communicate it early and often. People don't like to be blindsided by things, particularly things that are going to cost them money. So when you hear you're getting a big increase, start to communicate at the board meetings, at the budget meetings. Let people know this is coming and why. You as the board, you didn't do this. It's not your fault. This is a market-based, service that you're forced to buy. But give people enough time so they don't feel blindsided by it. Having your professionals deliver the message can be huge. I think you've all heard how in tune with the market and how well-educated Paul Mack is here today. Having somebody like Paul come down to your board meeting and explain to the community why the insurance has gone up 10, 20, 40, 50% is a way better option than you trying to do it as a volunteer board member. These agents will come to your meetings, and if they won't, you should find one that will. I know Paul does. And they should explain it to the people, and they should answer the difficult questions. You do not have to always be the bearer of bad news as a condo board member. So keep that in mind, leverage your professionals. And at the end of the day, yeah, rates may have gone up 50%, but if you live in a condo and you live on the water or near the water, this is still a great deal from an insurance perspective. An example condo we have has about approximately 1,100 units. Their total of all insurance policies is right around 1.7 million. That works out to just over $1,500 per unit to insure basically the entire envelope of their building, plus liability and umbrella. If you were in a waterfront single family home, that same type of insurance would cost you $6,000 to $12,000, maybe more, depending on where you live. So to achieve waterfront living here in Florida and to pay comparably that little in insurance is still a good deal for your owners in the condo. So do try to look at the big picture. Yes, rates have gone up, but it's still a bargain relative to some of the alternatives. So that puts us a little over half an hour here, Paul. So we should have some time to get to most of these questions. Let me see what we got here. Is there any occasion where where a condo would want to purchase property insurance coverage from a non-rated or non-admitted carrier?
Oftentimes in this market where we're at now, an admitted carrier is exiting the market, and the only options are going to be a non-admitted carrier. Most of the non-rated carriers are non-rated by AM Best, and those are the admitted carriers. So I think if you're going to deal with a non-admitted carrier, they should be rated by AM Best. Gotcha. I'd be very concerned about a non-rated, non-admitted carrier.
Okay. Someone asks about Demotech financial stability ratings. How are those related to AM Best ratings? Are you familiar with that term, Paul?
Yes. Yeah. So Demotech is a rating bureau like AM Best is. AM Best is probably the most widely recognized in the insurance industry, but they won't give a favorable rating to a one state domiciled carrier. So all your companies that go for AM Best ratings that are domiciled in Florida, they just won't even apply. So you get an NR, which is not rated. However, Demotech has stepped up for those admitted carriers like your American Coastal, like your Heritage, Tower Hill, and all these host of companies that write individual homeowners insurance, and have filled a need to rate these insurance companies because we really have no choice but to deal with them.
Someone asked about silicone roofs and the impact on insurance rates. Any knowledge or thoughts there?
I mean, insurance companies are looking at the age of the roof covering. That's the most important component when they're looking to do modeling. So, waterproofing and doing things like that and maintenance is important, but it's not going to have as big an impact on the pricing. It's kind of expected that the roof is in good condition, but the age of that roof covering is the key trigger to modeling.
What are the pros and cons of shopping the market right now? I mean, I don't think there's ever really a con to shopping, is there?
There's never a con to shopping. It's how you're going to go about doing that. If you're going to shotgun the market with multiple insurance agents, you're going to be you're going to be bumping heads, and that's not the way to go about it. The way to go about it would be to choose an agent, let he or she go and shop that market very diligently on your behalf, and request from that agent that they show you where they've been and what the disposition of those carriers are. If they've declined, why did they decline? Because sometimes you can overcome these objections of declination, but shopping is really important. Going about it the right way is almost equally as important.
We didn't touch on this, but it is a good question. When is flood insurance necessary or advisable? We didn't really talk about flood.
Yeah, no, that's a great question. So as an insurance agent, and in Florida, we're at sea level. So, some people view that we need flood insurance because we're at sea level. But generally what we see with community associations are the ones that are in high hazard zones. Everybody's in a flood zone. It's either a high hazard or a low hazard. And if there's anybody getting a mortgage and you're in a high hazard zone, you're going to be required to have flood insurance. So we generally see that when the market's competitive, we can buy flood insurance from private carriers, and we don't have to buy the full amounts of insurance, but we can buy something for those communities that are in a lower hazard zone. So, if there's ever some kind of event, at least they have something. In this market, when we're looking to control costs, if the premiums go up 50%, that's generally where they look to cut, is, something like that, where it's not, required.
Are carriers regulated, monitored, or controlled anyway by the state government and forced to keep rates? I guess, is there any sort of price fixing or rate justification required by companies operating in Florida?
Admitted carriers are required to file rates, but the state is not going to dictate what their rates are going to be. And that really varies too, depending on the administration that's in Tallahassee. So, when Wilma hit, what we saw the state step in and use citizens to subsidize rates, and that changed the market. But the state is it's a highly regulated business. So if they want a rate increase, they're going to have to file and get it approved. If they want to put exclusions on policies or change terms or change coverage, they're going to need approval of the regulators. But they're not, in this particular market, going to stop insurance companies from getting rate increases.
Is there a best practice in the amount of fidelity coverage an association needs? The answer to that is yes. It's not just a best practice, it's now the law. Florida statute 718 says you have to carry fidelity or theft insurance for the amount of money that you have on hand. So if you have $2 million in the bank, you should have a $2 million limit on your fidelity policy as an association. Ralph asks, since rates fluctuate, is it possible rates will go down next year? I assume he means 2023 because I don't think we
Yeah,
expect any sort of decline in rates in 2022. So,
that's correct. Yeah, I don't see anything. I don't. We try and do it 1 year at a time, but yeah, I mean, I think eventually rates are going to level off before they start to decline. But yes, I think eventually, if you look back historically, we will see a level off and then some kind of a decrease.
all right. I think we covered this some, but requiring impact glass on all units will have a major effect on the property casualty premiums. And the short answer is absolutely yes. Can
Yes,
be a
that is correct.
six-figure impact, right, Paul?
Yes, that is correct.
All right. Has Surfside affected D&O rates? I'm seeing that.
Yeah, I mean, I think a lot of things affect D&O, and kind of give yourself a different perspective of D&O, not just from a community insurance standpoint, because the carriers that write D&O for private companies, and think about how the pandemic has affected shareholder lawsuits in private companies and things like that. So I think that's going to have a great impact on it. And I think Surfside could have a indirect effect over the rates, but we are in for a correction on D&O coming
up. Someone referenced my previous slide. What did it mean when I said incumbent on the deal? That means the existing insurance carrier. If the existing insurance carrier would be considered the incumbent, if they stay, the increases seem to be lower than if a new insurance carrier needs to come in and replace an old insurance carrier. Is that your experience, Paul?
Yes.
Okay. We are going to replace our roofs over the next few months. Will our new roofs help lower the premium?
Yes. New roofs. As long as it's a new roof covering, it's gonna have a very positive impact on the modeling.
Right. This may be too hard to answer, but do you have any idea of kind of an average decrease when you go put a new roof on?
I mean, as a rule of thumb, if the rate is adequate, you could be looking at 20%, 10 to 25%.
And if let's just say the policy renews here November 1st or something, and they put new roofs on, in December or January, is there a way to get a credit for those new roofs when you're in the policy year or no? Or
that's hard. That's hard depending on the carrier, but in general, it's going to be at renewal when you're going to be able to negotiate. So I don't think so.
Okay. Someone asks, are shutters as good as impact windows when it comes to rating for insurance?
Good question. Yes, as long because the building is going to get a box checked or not a box check, and it's an opening protection. It doesn't specify. So as long as those shutters are FBC, Florida Building Code, the equivalent, where they meet the missile impact requirement, then the answer is yes.
This is an unfortunate situation. Someone asks, what should my association do if we cannot get any insurance at all?
Talk to another agent and get a second opinion. I mentioned to you it's important, and you depending on how you go about doing that, there's no harm in talking to multiple insurance agents. It's engaging the agent is where you want to make sure that you're engaging the right agent, because sometimes an association is dealing with an insurance agent. They've been dealing with this person for a long time. There's nothing wrong with going out, talking to somebody else, getting a second opinion. Maybe somebody's going to give you some ideas, and that will help you make the decision as to who you want to become your agent of record. Specific to the question, Citizens is there as a market of last resort. They do have issues. They do have requirements. So if the building has undamaged, as unrepaired damage, then they're not going to insure you. So find out what is the culprit as to why you can't get the insurance, and make a decision to fix it or not. There's a reason why you can't get it, and you probably can address it. It may cost you money, but you should be able to get it as long as you comply.
Let's see here. Someone asked us to clarify wind buyback. You brought up that term earlier, and that is a good question.
Yeah. Yep. Sometimes I speak insurance ease, but yeah. So sometimes the primary insurance company will call them, which call them the main and property insurance company. Will say, you know what? Let's say the building's worth, replacement value is 10 million, and the deductible is 3%, right? So we got a $300,000 wind deductible for that building. So the insurance company says, we're not going to go below that 3% level. You can go to a secondary market and buy that 3% down to any number you want. And that's what a wind buyback is. It basically reduces the amount of risk the association has to take. And we use a separate policy to do that.
Someone asks, can you discuss how these claims are, certain claims are subrogated against associations?
So this is a big thing with a lot of these homeowners insurance companies that write the individual unit owners insurance on the inside, have retained third parties to try and get money back for the insurance company writing the unit owners insurance. So water damage, and it was a pipe that the association was responsible for. So they're trying to subrogate, which is go back after somebody else to get their money back. And we see a lot of this. In fact, so much so that associations may be buying liability insurance, and that's, liability covers slip and fall, but it also covers property damage, which would fall under that subrogation claim. So some insurance companies have gotten savvy and said, you know what, we're going to put a special deductible on these subrogation claims. So you got $1,000 deductible for a trip and fall or, a regular property damage claim. But if the unit owner's insurance company tries to subrogate against you, now you got a $15,000 or a $25,000 deductible, which is, about what it costs to settle those. So effectively, you don't have any coverage anymore.
Right. Someone asked me to clarify my example condo with a $1.7 million policy premium. What type of policy is that? That is the sum of all of their insurance policies, property casualty being the bulk of that, but also GL, D&O, et cetera. So that was the sum of all insurances that condo carried. And let's see here. So Shirley asks, in her community, and I am familiar with this one, they have 22 separate condos. Can they do anything to save on insurance if they group together? And I do know this community, they are actually totally separate condos. They're not part of a multi-condo or anything.
Yeah. That's a great question. So there are pros and cons. Yes, you can do that. Yes, you can bundle these communities together. When the market is soft, it has a great impact because depending on the size of those 22 individual associations going to the market, there may be carriers that have minimum premiums, particularly on the property side. And, they can't offer a quote because they can't offer a competitive quote because it's below their minimum premium. And you just don't have the same number of companies that want to bid and, supply and demand. Right. Now, on the con side of that, there's some potential conflicts. So you put everybody together, and then one or two particular buildings are submitting a lot of claims or have a different philosophy as to how they want to utilize the insurance. And now there's some claims, and everybody's affected by that. So you got to be careful as to how you go about it. Make sure that you understand all the pros and the cons.
And there may be some legal issues there too, because they are completely separate condominiums. So I definitely want to check with your association counsel if that's an option.
Yeah. Well. One last thing on that too. You never, ever want to combine the D&O policies because those cover the boards and there could be conflict amongst boards. When you combine those policies, not only do you share limits, but then you eliminate coverage if one association goes after the other for whatever reason. So you never want to combine the D&O, the crime, the umbrella policies. Some of those policies, you got to be very, very careful about which ones you combine and which ones you don't.
All right. We have a couple of questions here about the timing of a renewal, basically kind of how far out can we expect to get numbers? How far out should we start shopping? That sort of thing.
Yeah. You can start shopping about 180 days. And, as I said, interviewing multiple agents is a good start. So you can do that 6 months ahead of the renewal date, and talk to agents, put a committee together, and establish some questions to see if he or she is properly qualified, and the agency has the resources to be able to handle the account. When can you expect to see quotes? You're probably never going to see quotes more than 30 days ahead of the effective date, just because quotes are only usually good for 30 days. But you shouldn't be seeing quotes, a day or two or within a week of the effective date, unless there's a circumstance. And you said it well in the beginning, communication is key, and communication between the agent and the association is key. I try and communicate with all of my customers ahead of time. Hey, this is where we're at. This is what we're doing. This is what I'm expecting. So if it does come down to the wire where we're actually implementing this, they're not, finding out about a 40% increase 2 days before their renewal. That's unacceptable.
We talked a lot about D&O, and some people asked us to clarify. Could you kind of go over that one more time? What exactly is D&O coverage?
D&O stands for Directors and Officers Liability Insurance. And for the simplest definition, it's management malpractice, because boards have a fiduciary obligation to make decisions and spend the members' money like it's their own. And a breach of that fiduciary trust, or a bad decision, or a management malpractice could result in a lawsuit or just a demand. And that's what it covers: legal fees for lawsuits over management decisions.
Thanks, Paul. So a couple people are asking kind of what's an average percentage decrease we might experience if we go with full, impact windows and doors and, across our whole building envelope.
Yep. Depending on where your current rate is now, but assuming that it's an adequate rate, and I would say anywhere from 20 to 40%.
Pretty substantial.
Yeah.
Okay. Someone asks about a marina. Does having a marina complicate your liability underwriting and potentially increase pricing?
I wouldn't expect it to complicate things. I mean, unless you're selling fuel and doing boat repairs, which I don't think any of them are doing that. If it's just boats that are being moored there, and it doesn't complicate it. There are plenty of insurance companies that can effectively handle that exposure. Some associations have a separate association for the marina, so you should put a separate program together. The second part of that question, it may increase the cost, but I don't think it's going to have a major impact on the cost.
So one of my slides referenced EFIS and buildings that have EFIS construction and potentially seeing huge increases or declinations. Can you cover what EFIS is, Paul, for the non-indoctrinated insurance people here?
Yes. EFIS is a exterior finish that insurance companies try and stay away from at all costs, also known as drive-it construction. It is a exterior finish that has been known to cause lots of problems, particularly with water damage, and insurance companies do not like it. So if your building has been insured with one particular insurance company that now has exiting Florida, they've left a very large gap in the market, and companies that do write EFIS are a lot more expensive than Everest, who was the carrier that left the state that wrote a lot of that stuff. So that's what it is. It's if you have it, you'll probably know. It should be contained in the appraisal, and it's like I say, exterior finish. Drive-it construction is also a commonly known phrase.
And just another point of clarification: can only the agent of record obtain insurance quotes?
Official quotes for a company. So let me kind of touch upon that a little bit. If you deal with an agent and he or she is covering the market properly and they've gone everywhere they're supposed to go, in theory, somebody goes in there and tries to get bids, isn't going to be able to, because your agent of record is doing his or her job properly. Sometimes, we talk to an association, and then we can talk to our companies, and they'll say, well, they haven't approached X, Y, and Z companies, and we won't need an agent of record. So the short answer is no, not every time. But if the agent is doing his or her job properly, then you probably will need to do an agent of record change.
Great. Thanks, Paul. Well, we're about 5 minutes from the end. I think we got through most of the relevant questions there. So thank you, everybody, for participating. Thank you for asking those questions. Hopefully you all took a little something away from this that you can take back to your condo, and whether it's reduce rates or just be more educated on how to understand what's going on in the market. I hope this was helpful for you. So if you need property management advice, if you feel like your property management company has not advised you on these issues as well as you would like, don't hesitate to reach out to me or Campbell. We've been doing this for a long time and are happy to help you. And if you don't feel like your agent has kept your best interest in mind or apprised you of some of these things that are happening, and you feel like you want to talk to somebody a little more dedicated purely to condominium and HOA insurance, please reach out to Paul. His information is here. So do answer our survey. We appreciate all the feedback to make these webinars better for the future. And at this point, I think I'd like to say everybody have a great afternoon. Any parting words, Paul?
I appreciate you giving me the opportunity to have this. Hopefully everybody has gained some knowledge and can be better consumers from our information today.
Thanks, Paul. Well, I appreciate you joining us. Everybody have a wonderful rest of your Tuesday afternoon. Take care.